Welcome, curious minds, to another deep dive. Today, we're really getting into the weeds with the recent financial results of Shyam Metalics and Energy Limited. You probably know them as SMEL. They're a pretty big deal in the multi-metal industry. We've got the official board meeting stuff, press releases, investor presentations, the whole lot. It all covers their first quarter for the financial year 2026, which ended back on June 30th, 2025. So, our job today: cut through all that data, pull out what really matters, and give you a clear sense of what's going on with them. What really catches my eye with Smell is this reputation they have for making profits year after year. I mean, in an industry that's famous for its ups and downs, right? That cyclical nature. So the big question we're tackling is, how do they actually pull that off, and what are they planning next?
Exactly. And this deep dive, it's a great chance to see how a big integrated metals company like Suxmel works.
Hmm.
It's not just about the spreadsheets.
Yeah.
It's the strategy behind it, the operational choices they make in a market that's always changing. It's really a fascinating look at, well, resilience and smart growth.
Okay, so before we jump headfirst into the Q1 numbers, let's just set the scene a bit. Who exactly is Shyam Metallics, for anyone who might not be following them closely?
Right. So Shimel is a major player in India's metal scene,
Hmm.
very integrated. They do everything from carbon steel, stainless steel, specialty alloys, even aluminum foil. They run on what they call an ore-to-metal model.
Or to metal.
Think of it like this. They basically control the whole chain, from digging the ore out of the ground
Hmm.
all the way to the final metal product that gives them a lot of control over costs and quality. Their main operations are spread across West Bengal, Odisha, Jharkhand, and Madhya Pradesh.
That sounds incredibly comprehensive, really controlling the whole value chain.
So how big are they, relatively speaking, in the Indian market?
Oh, their growth has been, well, pretty stunning. Just 2 decades ago, they weren't even in the top 35 steel producers in India.
Wow.
Now, they're the sixth largest. Plus, they're one of the biggest in ferroalloys, fourth largest in sponge iron, and a top player in pellet capacity, too. That kind of climb. It does make you wonder, doesn't it? How do they sustain that momentum in such a tough, cyclical industry?
That's the key question.
And as you said, this is where it gets really interesting, because they claim, and the record seems to back it up, they've made a profit every single year since they started back in 2005. That just seems unusual for this sector.
Yeah.
What allows them that kind of stability?
It is unusual. Highly unusual, actually. And look, it's not just luck. You see competitors swing wildly between huge profits and, frankly, big losses. Sesmel's consistency points to something deeper. Probably a mix of really tight operations, smart risk management, maybe investing cleverly against the cycle. It's a huge asset for them. This stability tells you a lot about how they run the company.
Okay, all right. Let's get into the latest numbers then. Q1 FY26, what are the headline figures telling us? How's the health of the company looking right now?
The performance was very strong for the quarter ending June 30th,
Yeah.
really robust. Revenue from operations shot up over 4,418 crores. That's a big jump, 22.4% compared to the same quarter last year. And even compared to the previous quarter, it's up 6.8%.
So solid top-line growth. What about profitability? Things like EBITDA.
Yeah. Operating EBITDA, which is a good measure of their core operational performance that grew almost 19% year on year, came in at 579.6 crores. It suggests they're managing costs well even while growing. Overall, EBITDA was also up 17.6% year on year, hitting 633.2 crores.
And the bottom line, profit after tax.
PAT, right. That landed at 290.7 crores. Now, the year-on-year growth there was more modest, about 5.3%. But interestingly, the quarter-on-quarter jump was really significant, up 32%. That shows pretty strong execution on the bottom line just in the last few months.
Those are definitely strong financials, but often the financials are just reflecting what's happening on the ground, right? Operationally. So what did we see in terms of actual stuff being made and sold, the volumes?
Good question. And yeah, the volumes tell a similar story. Overall sales volumes were up 32% year on year for the quarter.
32%.
Yeah, it's a big number. And it's important because it shows this isn't just about higher prices. They're actually selling significantly more metal. Demand is clearly there.
Okay, let's break that down a bit. How did the different types of products contribute? Did everything grow? And what happened with the prices they were getting per ton?
Right. So looking at volumes, iron pellets, which is a key raw material for steel making, saw huge growth, up nearly 50% year on year,
Wow.
over 312,000 tons. Specialty alloys were also up strongly, about 21.4%. Carbon steel grew, but more modestly, around 6% year on year. Stainless steel was up about 5%, and aluminum, which is another focus area, saw volumes increase by 19%.
Okay, so strong volume growth pretty much across the board, especially in pellets and alloys. What about the prices, the realizations?
That's where it gets a bit more mixed, you see. While overall revenue was up because of those volumes, the price per ton, the realization, it varied. For specialty alloys, it was actually down almost 10% year on year. Carbon steel prices were down about 5%. Sponge iron dropped over 11%. But, and this is interesting, aluminum prices, the realizations there, actually increased by over 12% year on year. So, real strength in that segment.
Interesting dynamic. Volumes up, but prices under pressure for some core products, yet strong pricing in aluminum.
Exactly. And they also highlighted sales from their brand new plants that just came online in Q1. Over 121,000 tons of pig iron and nearly 32,000 tons of CR coil and sheets.
From new plants straight out of the gate.
Yes. And get this, the new pig iron plant. It hit a utilization rate of 104% in its very first quarter of operation.
104%. How is that even? I mean, that's incredible for a new facility.
It really is. It points to, well, exceptional project execution. They got it built, got it running, and found the demand almost immediately. Very efficient ramp up.
Yeah, that suggests they're getting returns on that investment much faster than you might expect. The chairman, Mr. Bred Bhushan, he linked this performance directly to their strategic initiatives. So what are those key strategies and how are they translating into these kinds of results?
Well, the management commentary really hammers home two things: operational excellence and expanding into higher value-added products. That pig iron plant hitting 104% utilization and the new color-coated plant reaching 68% utilization already. Those are highlighted as key successes. It shows they don't just build things, they make them productive very, very quickly.
It really sounds like this relentless drive for integration and diversification we talked about earlier. Can you give us some more concrete examples of how they're driving integration, as they put it? What's the end game there?
Sure, they're doing both backward and forward integration. So backward means controlling more raw materials like the iron pellets and sponge iron we mentioned. That helps manage costs and ensure supply.
Right.
Forward integration means moving closer to the final customer, making more finished goods like TMT bars for construction, those CR coils, stainless steel products, aluminum foil, things people actually use.
Got it.
And the strategic goal is pretty ambitious. They want 80% of the revenue to eventually come from these higher value finished products.
80%. That's a major shift.
It is. In Q1, intermediate products still made up 45% of revenue. So it's a clear strategic direction, capture more value along the entire chain.
Makes sense. Control more, earn more on the final sale. But, okay, all this growth, these big plans, they need funding. We know they talk about being disciplined, funding CapEx internally.
Right, from their own profits.
But then the board just approved raising potentially quite a lot of money, up to 4,500 crore through equity routes and another 3,000 crore through NCDs. How does that square with the internal funding approach? Seems a bit contradictory, doesn't it?
That's a really sharp question. And it highlights, I think, a nuance in their approach. Yes, their stated policy is funding CapEx, building plants, buying machinery from internal cash flow. They only go to banks for, say, working capital needs. And they keep that debt-to-equity ratio super low, capped at 0.5x. That's very conservative. The recent board approval to raise funds. Think of it less as abandoning that discipline and more as creating options for future, potentially larger-scale growth or strategic moves. The equity part gives them flexibility, maybe for a big acquisition down the line, subject to shareholder approval, of course. And the NCDs, non-convertible debentures, that's basically long-term debt, raised directly from investors, not banks. It allows them to potentially fund bigger projects without straining their regular bank lines or significantly diluting existing shareholders right away.
Okay. So it's about preparing for bigger opportunities, getting the approvals in place without necessarily changing their day-to-day philosophy on funding core CapEx.
Exactly. It signals readiness for accelerated growth if the right opportunities come along, while still aiming to keep the main balance sheet very conservative. Strategic flexibility, you could call it.
All right. That clarifies things. So with this potential capital firepower, where are they actually putting their money? Or where have they been putting it recently? Any standout projects?
Oh, definitely. They've already spent a lot, over 7,000 crores in CapEx, up to Q1 FY26. That's 70% of the total planned outlay of around 10,000 crores. So they're executing fast.
Okay. What are some key examples?
Well, there's the big cold rolling mill in Jamuria, West Bengal. That's a brand new greenfield project. Phase 1 is already up and running, making galvanized and pre-painted steel, higher value stuff used in construction, appliances.
Right, moving up the value chain again.
Exactly. Then there's stainless steel. They bought a company called Middle Core and have since pumped in another 225 crores to boost capacity and grab more market share in that premium segment.
Makes sense.
Aluminum foil is another big one. They're planning a major greenfield expansion, investing 700 crores to make more flat roll products and foil. They're already a huge player here, especially in exports, so this is about doubling down on a strength.
Okay.
They also bought a 60% stake in Ramsar Up Industries. That company makes wires, TMT bars essential for construction, and other steel products. They're commissioning a blast furnace there soon. More integration.
And anything completely new, any diversification.
Yes, and this one's quite interesting. They're entering the rolling stock business, building a brand new factory in Karakur, West Bengal, to manufacture railway wagons.
Railway wagons, that's different.
It is, costing about 300 crores, aiming for phase 1 operations by March 2026. It ties into the whole Make in India push and gets them into the infrastructure space, which is, generally quite stable, a strategic diversification.
That's a pretty broad range of investments. So with all this activity, the spending, the strategy, what are they projecting for the future? How fast do they think they can grow?
They're putting out some ambitious targets. They expect to roughly double their revenue.
Double?
Yes, double revenue, and grow EBITDA by about 2.5 times over the next 5 years.
Wow.
And what's interesting is they say they can achieve this with what they call conservative growth rates, like 15-17% CAGR for revenue, 18-20% for EBITDA. And crucially, they plan to do this without raising any more capital beyond what's already outlined, and while keeping their ownership stake at 75%.
That implies a huge confidence in their existing operations and their ability to generate cash internally, doesn't it?
It really does. It suggests they believe their model is strong enough to self-fund that significant level of growth.
Okay, stepping back from the specific projects and numbers for a moment, what are the fundamental pillars, the core ideas, guiding their overall strategy going forward? What's the philosophy?
You can break it down into a few key areas.
Yeah.
First, that diversified product mix, aiming for leadership across all their segments, steel, stainless, alloys, aluminum, and hitting that 80% target for value-added products.
Right.
Second, geographical expansion, pushing into new regions within India, building their brand, and try to capture better margins. Third, relentless cost efficiency, always looking for ways to improve operations, using technology, integrating more backward, squeezing out every bit of cost they can.
That seems crucial in metals.
Absolutely. Fourth, sustainability. This seems genuine. Reducing their carbon footprint, using green energy.
Right.
At that point, about 78% of their power coming from their own captive plants using waste.
At just ours, 2.4 over per unit.
Exactly. That's a massive cost advantage over relying on the grid. Huge.
Definitely.
And finally, underpinning everything is that disciplined capital management. Achieve all this growth, but don't load up the balance sheet with debt. Stick to the plan.
That financial discipline really does seem to be the bedrock. So how do outsiders, like credit rating agencies, view their financial health? Does it reflect this discipline?
It absolutely does. And this is a really important point for anyone looking at the company. They hold a long-term credit rating of CRISIL AA with a positive outlook. That review was from November 2024.
AA positive. That's very strong, isn't it? Especially in this industry.
It's extremely strong. They actually state it's the highest credit rating in the industry. What it means is CRISIL sees them as having very high financial stability, a very strong ability to meet their debts. It means they can borrow money more cheaply than almost anyone else in the sector.
A significant competitive advantage, then.
Massive.
Yeah.
It reflects that strong balance sheet, their consistent profits, the fact they were cash positive in FY25 with over 1,000 crores in the bank. It validates their whole approach.
And finally, for the shareholders themselves, any news on dividends, direct returns?
Yes, the board approved an interim dividend. It's Rs 1.80 per equity share for this financial year, FY26, and they mentioned it's payable within 30 days. This aligns with their stated policy of allocating about 10% of profits back to shareholders as dividends.
So consistent returns there, too.
Yeah, it seems to be part of the overall package.
Yeah.
So wrapping it up, what you see with Shyam Metalics is a company that seems to have found a really effective formula. They're growing aggressively, diversifying, moving into higher value products, but doing it all with this incredibly disciplined financial management, their track record of profitability, these expansion plans, the focus on efficiency. It paints a picture of a very resilient and strategically smart company.
Absolutely. This deep dive really highlights that unique blend, doesn't it? That aggressive ambition and coupled with, well, almost conservative financial principles. It makes them a fascinating case study in how you can potentially achieve consistent success in a notoriously tough global market. But, while this Q1 picture looks very positive, you always have to ask, what are the potential bumps in the road? Where could this strategy face challenges?
That's the million-dollar question, isn't it? They operate in a cyclical industry subject to global commodity prices, demand fluctuations, energy costs. So how well can this model, this combination of aggressive expansion funded internally and strict financial discipline, hold up against major unforeseen market shocks? Could their very conservatism, that reluctance to leverage up, maybe cause them to miss out on a really big opportunity that a more, shall we say, adventurous competitor might grab? It's that balancing act. How sustainable is it in the long run, especially when the unexpected inevitably happens? That's definitely something for you, the listener, to think about.